All right, here we are again. For everybody watching, this is Clint Sorenson. Clint is my partner at ORG Partners. He's our CIO, the man that I follow his guidance on my recommendation to you guys. Co-founder of Wealth Shield as well. So you guys have probably seen Clint before, seen me use some of his material. I thought it was timely, given everything that's going on and things that we've been talking about the last few weeks, to bring him on, let him kind of walk us through his thoughts of where we're at, where things are headed, and then maybe some opportunities and how to take advantage of what we might see coming up this year. So Clint, thanks for joining, brother.
Yeah, Dana, thank you for having me. And thanks everybody for joining us. It's exciting times, to your point.
It is interesting times for sure. So, let's just get right to it, man. I'll get out of the way, let you start rolling through your thoughts here, and I'll chime in when I have a few questions and we'll go from there. Sound good?
Yeah, I think that's perfect. Yeah. So everybody, this is it's unique times. And I was telling Dana before we got on, this is the most bullish I've ever been on investing opportunities in my lifetime. So I started my career back in 2006 in the space, worked for a big bank, and then eventually joined into running an asset management company, or started an asset management company back in like 2015. And I remember during that time, that was what I started with, right? Was this amazing opportunity, which I thought was a crisis. And we're in a similar environment today. And so I'll share with you a little bit about the big cycle, kind of what's driving everything from a long-term perspective, what opportunities that presents. And then I'll also talk cyclically. So what's going on in the medium term? And there's a lot to be gained from that, because our basis, Dana and I, we talk about markets all the time. We don't have to predict where markets are going if we can measure and map where we are. And if we can be in that moment and invest according to where we are from a cycle perspective, we know that we can stack probabilities in our favor. And so that's what we try to do. And that's what we're going to do today. So when you start off, our framework is what I think separates us or sets us apart. And what a framework is you have to have a philosophy, and this philosophy has to be grounded in academic discipline. It's got to be proven to have worked historically. And so what we did being young is we borrowed credibility. So it's a natural process where we say, hey, plagiarism is only frowned upon in schools. We can borrow from the greatest ideas of these unbelievable investors that we've been able to see outperform the market and build incredible wealth and support philanthropic causes and do incredible things for society. And we get to follow and model those behaviors. And that's what we've done with our framework. So we started off and said, hey, everybody's heard buy low, sell high. That's our valuation components. You see that there at the bottom. We just want to measure and map whether the market's cheap or expensive. And you might say, what market? Well, we're talking about stocks, bonds, foreign markets, alternative markets, private businesses, everything. We want to measure and map valuations on everything and determine what are the opportunities for above average returns. Buy low, sell high. We borrowed that from the greats like Warren Buffett, Seth Klarman, Peter Lynch, right? The tried and true value investors. The next thing we do is we look at the economic cycle and the Fed. And that's what I'll talk about and center our comments on today, is a lot of those two factors. Well, the reason why is because valuations are really long term. Everyone wants to buy low, sell high, but when you say you got to buy today and wait 12 years before your investment makes any money, that's a different story. And that's what value investing often takes. It takes a very long-term period of time for something to go below fair value to back to fair value. So we have to couple that with something a little more medium term. And that's why we measure the economy. Now, the economic or the business cycle typically lasts 2 to 8 years. Yeah, the wide margins, because since the Fed started QE and printing money to infinity, which we'll talk more about here in a second, at the end of the day, we used to have a very long business cycle of 8 years. Once the Fed started printing money in 2008, it shrunk that business cycle to about 2 years. And so that's our reality today. But we measure and map, hey, are we slowing or are we accelerating from a growth perspective? And the same we look at from an inflation perspective. And then we measure and map the next component, which is the Fed tightening or easing into that? And so you can already know where I'm going to go with this presentation today based on where we are today, if you pay attention to where growth and inflation are. And then lastly, we look at market price trends. Price trends are important. They're the sentiment of all market participants. And we don't think that we're smarter than the sum total of all those participants. So we measure and map price action, and we study price because we feel like price has a tremendous amount of information. And we borrow that methodology from the greats like Paul Tudor Jones, who said the three best indicators of the market are price, price, and price. So we borrowed that from him. He's a famous trader. And from the economy, inflation, and the Fed model, we borrowed from the greats like Ray Dalio. So where are we today? From a valuation perspective, if you look at the US, which is that top bucket, that's called the Buffett indicator. And if you just look to the far right, red is no good. We are in the top decile of historical valuations. And if you bought and held the S&P today, the expected return on average over the next 12 years would be a return that rhymes with hero. That's right, zero. So 0% is what you're expected to earn if I bought the S&P 500 today and held it. And I know what you're thinking. Well, we were down a lot last year. That doesn't matter. That just shows you the magnitude with which the bubble we were in created by easy money from the Fed. So
just one point on that, I think it's interesting, and our careers have been about the same in tenure. It's not often that it's, I agree with you 100% on that opinion. I always trust and follow your advice, but it's not just you. It's not just us, right?
No.
And 2 weeks ago, I showed these guys Morgan Stanley's opinion, JP Morgan, the list goes on. It's not very often when everybody's in consensus that things aren't going to be that great over the next 5-10 years. So
that's exactly right. And when Mike Wilson says anything, I listen, right? So, I mean, he's, I've got to always give credit to where credit's due. He and Mike Cantro from Piper Sandler and a number of other strategists, just phenomenal at their jobs. And I think that's so wise that you get all these different diverse perspectives, but it is scary, Dana. We all agree. You can't deny the evidence. And that's what we've always centered ourselves on. We said, you know what? I read an article one time that economists and market strategists and weathermen weren't too different. And in fact, market strategists were worse. And I said, well, you know what? The best weathermen I know, they go outside and they say it's raining today, so bring an umbrella to work. And so I said, that's what I'm going to do. And so that's what we've done from this perspective. So you can't argue the facts, right? If I said the market's overvalued, that is not a perspective. That is literally a fact. If I look historically, we're in the top decile. Now, on the flip side, emerging markets and international markets are cheap. And I'm looking at that, I'm thinking, wow, that's something interesting, especially when you start to consider the long-term cycle, which we'll get to in a moment. When you also look cyclically, you can see that we're in this period of what I call the lag period. Now, Piper Sandler, Michael Cantro that I just referenced, I'm gonna go ahead and give him a shout out. If you think about what his model is about economic model, is about how slow the Fed funds rate increases. So the Fed tightened policy by raising interest rates, how slow that works its way through the economy and the order with which it typically does. And I find this work incredibly interesting because what we have is this dichotomy between leading indicators, which you can see on the bottom, and lagging and coincident indicators, which you can see on the top. Now, red means contracting, yellow means slowing, green means accelerating. And when you look at this, you're thinking, okay, well, I can see why people are saying soft landing or no landing, Dana, right? Because they're just paying attention to coincident and lagging indicators. But if you're looking at leading indicators like we are, we're saying, okay, we're in what I call the lag period. And that lag period is what Michael Cantro references. He says that first, interest rate hikes work themselves. It takes about 16 to 18 months for interest rate hikes to work themselves through the economy. And at first, they work themselves through housing. Well, guess what? Housing's been broken. Existing home sales are at the lowest rate of change that we've seen, even below the financial crisis of 2008. So you have existing home sales down over 36% year over year. That's amazing. Housing starts in decline significantly. You've just had this massive, and it makes sense, right? Interest rates on mortgages went up to 7% from 2.5%. So major increases, and that's an effect of the Fed. And that works its way first through housing, then through new orders. We've seen that in manufacturing. You can see that in industrial production, almost negative now, only up a little over 1%. Right. And then it works its way through profits. We just saw year over year profits of the S&P dip to down over 5%, almost 6%. In the fourth quarter, earnings were down over 23% year over year. So profits are now declining. The last thing is employment. And that's where everyone's kind of hung their hat on this soft landing idea. But if you look at leading indicators, you can see when we break it down, look at housing. Housing still in contraction, down 4.36 on our metric. The consumer is in contraction, down 1.3. Financial conditions, which is the Fed tightening and the effects on the yield curve, that's negative. And we're seeing that manifest itself into banks, Dana. We'll talk about that here in a second. The only strength is in sentiment and labor. And labor's tight for structural reasons, and we think that that will break down. And market prices are also neutral. If you look at asset classes, domestic equities are still underperforming, cash and negative across all time periods. High yield bonds are positive across the short term, international positive across the short and intermediate. So this is like the, not completely negative, but in that neutral to negative camp, which just says, hey, you need to be defensive.
So can I jump in with a question here?
Yeah, for sure.
Cut me off if you're going to get to this, and I'm jumping the gun here. We've had a lot of conversations about traditional investments, just purely, quite simply meaning, publicly traded stocks and bonds.
Yeah.
We know equities, we know what they do. We just mentioned a little bit about what may happen the next foreseeable future, right? Maybe even longer term. In my opinion, I think sometimes people still look at bonds as their safe investments, even though if you look at last year's returns, you have equity-like fluctuation, you don't have the yield. And given where we could be going, just 2 seconds on your thoughts on that and the actual risk of fixed income, because I think that gets overlooked a lot.
Yeah. So, and it comes down to this chart, Dana, that I've got up here. So that was well timed, and that was not planned, folks. That was purely authentic. Yeah. So if you think about this, if you look at the economic cycle and you say, where are we from a growth perspective? We're clearly slowing. So we're in that bottom left and right. So below that halfway mark, we're in those bottom two quadrants just based on growth. And then you look at the direction of inflation. And right now we're in that declining inflation mode, which means you need to have risk mitigation in the portfolio. That doesn't say you need to have bonds per se. It says maybe long-term treasuries in this quadrant work well. But other than that, you're going to have to start looking at alternative ways to preserve capital. This is all about managing risk. So there's several ways to do that using alternative assets. You can have short bias funds. You can have systematic diversified trend following strategies. You can have, short bias funds would be like long, short hedged equity that's really focused on the short bias. You can have absolute return strategies, all kinds of arbitrage strategies within this bucket. So there's a ton of things you can do in this area to manage risk other than just traditional bonds. And we saw that last year because what's likely to occur, which is what happened last year, is we bounced in those bottom two quadrants. So we went from 2021 being in that top right, where we had growth accelerating, inflation accelerating, the Fed had to ramp up rates. That environment was great for everything, just blowed up risk, right? Because you want to enhance returns. Well, then we flipped from being in that quadrant to the bottom right. So as soon as the Fed started yanking on the hiking bucket, growth started slowing in the first quarter of 22 into the second quarter of 2022. And the Fed was continuing to hike in that, and inflation remained stubbornly high and increasing. So that was a really bad environment. That's why everything got hit, because you need risk mitigation in real assets. But in this quadrant, long-term treasuries don't play out. So treasuries sank as well as fixed income. So the 60-40 got murdered.
Yep.
It was only systematic diversified trend following strategies and absolute return and a select few real asset strategies like energy plays and real estate that did well last year, because we're in that bottom right quadrant for the bulk of the year. But now we're in that bottom left. And so now you need to be focused entirely on managing risk within your portfolio. Now, eventually, when the Fed pivots and really pivots, prints money pivots, right? They're not only just cutting interest rates, not only pausing, which they may do this time around, but cutting interest rates 100%, cutting them 50 basis points, another 50 basis points, stopping QT, ramping up QE, pivoting. I think we go back in that upper right quadrant. And I think the opportunity is in these regime changes, Dana, because the Fed has moved from an environment where since the global financial crisis, they've been able to manage the business cycle by just stepping on the gas pedal or printing money. Mm-hmm. And that's it. They never had to raise rates. They raised rates one time in 2015, and Janet Yellen had to do it about face, and the whole globe got sunk into a recession and had to launch negative interest rates based on us hiking rates one time. That's how sensitive to policy this entire system is. It's fragile. And then in 2018, Powell lifted rates a few times, and guess what? Had to do an about face and cut interest rates 3 times in 2019 before expanding the balance sheet on the face of COVID and said, hey, hold my beer. I'm going to print 4.4 trillion in 2 months.
Right.
Like, This is not the Fed driving with the gas pedal anymore. It's the Fed driving with nitrous and a parking brake. And so we've got to be flexible and nimble, and public markets are just not going to do it unless you have an incredible trader trading those assets for you. It's just simply going to be too volatile. And that's the model that, if you look back historically at these stagflationary regimes like the 70s and 80s, these regime change areas where we went off the gold standard in 71, completely new regime, had a spike in inflation, a young demographic, a fourth turning like we're having now. A lot of the same things were occurring back then. It's a very similar environment. And we had extreme volatility in all asset classes, but there's a few things that did well. And that's what I'm going to share with you today at the end. So what's the Fed doing in the face of this? We just said growth and inflation are both slowing, Dana, right? Yep. Problematic. Problem number one, we have more of a risk of deflation than inflation, at least in the short term. And the Fed's going to drain liquidity out of the market. The Fed's balance sheet, so at the beginning of 2008, was less than $1 trillion. It was $890 billion. It rose to $9 trillion. $9 trillion by 2021, and we printed 4.4 trillion of that in 2020. I mean, you can't make this stuff up. It's unbelievable.
Seen this chart 100 times and it's still
it's just baffling. So no wonder the stock market went up, but the stock market is underperforming the percentage increase in the Fed's balance sheet. So like they did this to kind of protect us from ourselves, understanding that we were in an economic depression. And I'm going to quote Bill Clinton. My name's Clinton, but it's not Bill Clinton. And he said, it depends on what the definition of is. Well, it depends on what the definition of economic depression is. But my definition is a prolonged period of subpar economic growth. Now, that's also a textbook definition, so you can validate that if you will. But if you look at that, we've been subpar since the global financial crisis. So this gray area, that's where we went below trend, and we've been below trend for a long time. So the Fed was able to print money to try to catch us up. And that's why we never really felt the effects. So good job by the Fed. They did a marvelous job under Bernanke, then Yellen, and Powell. But now we're in a very different regime. Now we're selling bonds and we're raising interest rates at the fastest clip ever. If you look at it exponentially, it is the fastest rate of change in tightening ever. And what does that do? It always breaks something. This is from Bank of America, not from me. Then you can see this clearly, that every time we raise interest rates like this, we break something. And folks, we have broken a few things. Now, despite what Janet Yellen says, that we will never have another financial crisis in her lifetime, which was in 2007. Yeah, that was 2017. So not to pick on her, but this is why you don't make predictions, especially about the future. You just don't do it, because you end up eating your words. So she said, hey, no more financial crisis as long as I live. Well, we're here. And we've been in one. And you can see that by the line outside of Silicon Valley Bank, as we had a good old-fashioned bank run, not only on them, not only on Silvergate, not only on Signature Bank, but now I'm hearing tonight that a bank that I actually bank with, but not above the FDIC limits, although that would be guaranteed now, with First Republic Bank. And now First Republic Bank is shopping options to sell, because this is what happens in a financial crisis. This is why it terrifies folks. This is not an asset crisis. This isn't a bad debt crisis. This isn't a subprime mortgage crisis or any risk management crisis. Maybe in Silicon Valley's case, but the other one's not. This is a sentiment and a confidence crisis. And that's what we're witnessing today. And it's going to get materially worse. And so that is what we face. And Silicon Valley Bank was the first thing to show why it broke. Now, when anybody asks me this, I'm a simple person, right? I live in the country of North Carolina. I went to UNC Chapel Hill. Don't hold that against me. We couldn't make the NCAA tournament this year. We were preseason number one, but we set a record.
NITs, so
yeah, we're in the NIT. We set a record. Right?
You handled it well.
First preseason number one team to not make the tournament, but we'll take that in stride. But if you look at that, right, despite all that, I like to come up with simple models for everything. And I've got a philosophy, Dana, and you've heard this a million times, so I apologize about the redundancy, but
good stuff though, brother.
Yeah, at the end of the day, liquidity drives markets. It is as simple as that. Our entire business structure is based on leverage. Everything, our entire business model, our entire money-making system, our entire economy is based on leverage. And this leverage, right, is very important. And it's the creation of additional units of leverage that drive the economy. So it's not the absolute level.
Mhm.
It's our ability to create and print money and credit. And that has come to a complete halt. M2 money supply growth. After Chairman Powell decided that we could print money digitally, and he went on 60 Minutes and said so boldly, after he decided to print all this money, 4.4 trillion, and then partner with the federal government, because the Federal Reserve is actually not the government. As they partnered together to print additional money, they decided the federal government would print an additional amount and do a little bit more than what the Fed did from a balance sheet perspective. Well, what that did is create money supply growth. Here you can see that this huge peak, the historic peak of all times. And this chart goes back to 1863, folks. If you look at this, the largest peak in money supply growth in history was Jerome Powell. And now the first shrinkage in the money supply since the Great Depression. That's a scary comparison. So liquidity drives
2007 to 2009 looked like a
it looked like the sandbox. That's right. It looks like a warm up, a dress rehearsal. This is not good. And this is when, and I'm not blaming the Fed. They have a terrible job. They're doing all that they can do. But this is going to mean problems if your only investment world is public markets.
So can I ask a few questions on that?
Absolutely.
So you just showed the picture of the Brinks truck in front of the bank. You just went through this, which just the visual alone to me is shocking. And I don't think most probably don't understand this, right? To the level that you do and just explained. But most, in my opinion, just the many conversations I have direct with investors, don't understand the implications of this. So can you kind of let's back up a second, walk me
through. Think about it like the economy is a human body. And the flow of liquidity, credit, and money creation is blood. And the heart is the Federal Reserve that beats out that blood. And all of a sudden, that heart stops beating. What happens to the body?
That's pretty intense.
That's what happens to the body. And it first starts manifesting as close to that heart as possible. So the Federal Reserve means what it first starts affecting is financial institutions and things that are highly leveraged or things that have a tremendous amount of duration. So when did it hit? The most financially duration assets in history, which are venture capital and innovation. It hits crypto. It hits things that are based on a long timeline that are going to change society and change the way we consume and change the way we do anything, right? These disruptive technologies that have created fortunes by people investing and betting on those have relied on one thing and one thing more importantly than any other, and that's time. And when you make time costly, by draining liquidity, those things get hit first. And so venture capital got smoked. And now think of it just in a degree of leverage. Everything leverage starts getting smoked. And that's where we're at. And then we have things that have a delay to them because of private markets like real estate, where the math problem just hasn't manifested in reality yet, and it's coming. Commercial real estate, in particular office, is going to take a beating. It's already taken a beating. Office, I mean, you've seen major defaults, billion-dollar defaults in office space. People are taking and choosing more of a hybrid work approach than a return to office approach. All these things manifest themselves in deep losses. And between 2023 and 2024, there's said to be over $1 trillion in debt that has to roll over. And they're not rolling over at low rates. They're rolling over into an adverse financial lending environment where banks are tightening credit standards. They're rolling over into rates that have doubled or tripled since then. What do you think that does to their IRR?
But it's an interesting point for all of real estate, right? And I know we've talked about this. I talk about it with clients all the time. Our focus is alternative assets, right? Creating consistency of returns, owning real assets, what that does to your portfolio. You already mentioned it. I know you're going to probably go into it a bit more. You usually do. But just going to the level of understanding that, right? And looking at other options, other investment options out there that I see that look great right now. But if you can't future pace that 12, 24 months, when just what you talked about happens, I mean, it's scary as hell to me that people are setting up themselves for what looks good right now, but don't have that 2, 3, 4, 5 year outlook of what that asset class is going to do or that particular investment is going to do. So I know we pay a lot of attention to that in my shop. through
Yeah.
you. And it's something people, I hope everybody listens to that, because a lot of my investors are heavy in real estate, and
Yeah. And real
a lot of
estate's
opportunity,
great.
but there's a lot of scary situations there right now too.
Yeah, there's a math problem, but you know what? I love these scary situations, Dana, because they create opportunities and opportunities of a lifetime. Like, we've been in an easy world, right?
Mhm.
People are buying 3 and 4 Airbnbs without ever studying real estate, putting in no time and making money, making fortunes, right? You have to have corrections. Corrections shake out the weak hands, and they bring in the real players, and they create opportunities for the astute and the prudent. And I
Mhm.
think we're in that time. That's why I said, and I started off, I have never been more excited about investment opportunities. And here's why. I think the endowments nailed it, right? We talked about this a lot. My buddy Mev Faber wrote a book called The Endowment Portfolio. Highly recommended. It was formed off a white paper that was the most downloaded white paper in our industry for a number of years. It might still be. But in this paper, he kind of highlighted, or this book, he highlights what the major endowments do so different. Well, look at their allocations, Dana.
Yeah.
Look at the percentage in public equities. It's nothing. These are the top 3 endowments. And you can replicate this type of strategy very simply. So we did it here, just as an example. We took the allocation of Harvard, Yale, and Texas, and we just modeled it by indexes. So we just took their weightings and used the relative index, which we have listed below. And then we said, what if you just do a third, and kind of our base market base, like private asset mix that we would do based on today's environment. And the reason you do this is to see how it performed in an environment that should be adverse to it, right? A deflationary, globalized environment where rates are falling, everything's efficient, right? It's a perfect environment. Debt expansion's happening, not debt or money supply shrinkage. That's all supportive of growth. And even in that period, that light green line, that private market strategy of just indexes and the weightings that we suggest today outperforms those 3 endowments.
Yeah.
Or at least comes really close to matching it. And then when I compare it to the S&P, it's significantly better. And the 60-40, it's not even a comparison. And I'm thinking, it's
I preach
nothing.
consistency of return. I mean, you're telling my story for me here.
Yeah,
And
it's like smooth the
everybody
ride.
listening is clear. What third? How do you break it down?
So what we did was we just did a simple deal. So we based it off those endowments. We said, okay, well, they've got very little in public equity. So what we're going to do is we're going to take a third. We're going to put it in equity. We got it in private equity and venture capital, because we want to say that private markets could be superior to public markets. So we've had split evenly private equity and venture capital. So 12.5% 15%, or a little over that, right?
Yep.
To get to 33%. And those 2 buckets we used the Cambridge indices. Then we did 33% in trend following, because we wanted commodity exposure. We talked about this earlier. We want to be able to trade trends in commodities, crypto, currencies, interest rates, stock indices, individual stocks. We want the ability to go long and short all these different asset classes when we're changing regimes, because that creates resilience in a portfolio, right? We don't have to predict anything. We just ride the waves. And we saw that in a Man Group paper back in the inflationary periods, which they tested, that all asset trend following outperformed every other strategy in inflationary periods. So we were like, hey, we want that, because we could be in this deglobalizing world with rising costs and falling growth, and we need resilience. So that's kind of the seatbelt or the airbag of the portfolio. And we use the SG or SG trend index, very common index. And then the other third was commercial real estate. And we just used the neck reef index for commercial real estate. It's a blend of all different asset classes in commercial real estate. So it's a very simple model. And look at it. Like, I would take that return all day. And I know it doesn't include transaction costs and taxes and everything else, but this is to model the smoothness of the ride. I'm not worried about the return or any of that. It's like, hey, I can get a smooth compounding ride. Yep. And that's what, in my opinion, I'm after as an investor. Like, I want that top line. And so that's what I look at. Now let's talk about the opportunities in real estate, Dana. As you mentioned, real estate.
Yeah.
This is why I love real estate for a third. It's a real asset that generates cash flow. And if you go into a secular, a long-term stagflationary environment with falling growth rates due to demographics and rising cost rates due to deglobalization and geopolitical conflict and decarbonization, all 3 of which are inflationary, then you need real assets. You need something to keep up with inflation, to preserve value during inflation. And then I want cash flow. during that period, because whoever has cash flow is going to be king. So commercial real estate fits that bill. And when I look at the index, Dana, it's not cheap yet, but it's fair valued.
Mm-hmm.
And so when I start to factor in the fact that we're going to continue to see defaults in the office space and probably a credit event that's pretty scary in commercial real estate, where commercial mortgage-backed securities, or CMBS, we're going to see some major issues there, and maybe even some banks, regional banks that have a big exposure on their balance sheets to commercial real estate or commercial mortgage-backed securities go under. I am fully expecting that, but with that comes opportunity, and the asset class is already fair valued. Markets, as I just went to you, are like up here. They're overvalued. And we've got commercial real estate that's fair valued, but wait until I dig deeper. Look at office declining. I expect office to get a lot cheaper. I think this is the area you want to avoid, and eventually will present one of the biggest opportunities ever. What I like is a few things. Number one, industrial real estate. Number one, because the trend is just, see, this is a breakout. Major breakout. This is a paradigm shift in 2020 created by COVID, where we fast forwarded e-commerce. Now, everyone's got to have last mile logistics centers that are small. I know companies that are creating smart cubes, that are developing technology to essentially create a franchise model for the creation and manufacturing of chips in the US. Onshoring is real. Demand for this space is massive, and it's not going away. What's going away potentially, at least in the intermediate term, is the 1 million square foot spaces, the Amazon warehouses of the world. Those are shrinking. I am bearish that. And so I do expect this to come down, because if you think about an index, these huge square foot properties, when the prices come down and these things have their struggles and have to be broken up and reconfigured for industrial demand, they're going to fall. The prices are going to fall. But those last mile, smaller logistics centers, I'm super bullish on. I think in distress, you have to buy this asset class. Next up, because you're investing in innovation passively through that.
Mm-hmm.
Next up is, I think, retail. The retail apocalypse did not happen. You know what happened? People moved to suburban areas, and grocery anchored retail has taken off, and it is dirt cheap. Dirt cheap. So I've been on a search over the last, call it 18 months, and we have found kind of our partner manager in this space, Dana. The retail real estate is very attractive. Grocery anchored retail in suburban marketplaces is attractive. We're not going to go out and want to invest in malls, folks. But these mixed use facilities in A areas in cities, and then suburban grocery anchored retail is a home run.
Which,
and I think
common sense, right? Go outside and look around.
Yeah, go outside and look around and look
So
at it.
Are we allowed to talk about our partner on that?
Yeah, we can. Yeah, we can actually. I'd love to recommend them, but it's Prep Securities is who we use there. The founder, he worked in retail, starting facilities for like Ralph Lauren back in the day. So they've been in this space for forever. Family office, long-term investors in the space, do phenomenal. They even own luxury real estate, luxury hotel real estate. I was out visiting with them in Salt Lake City the other weekend, or actually in Deer Valley. But they're phenomenal. So Dana, I think instead of stealing the thunder, I think you have them on. They're incredible, because this is one of the biggest opportunities I see. And as this market and as this financial lockup occurs, because the Fed was intending on breaking demand and they've broken demand, and if they continue to tighten, you're going to have problems. These problems create opportunity for your viewers, because this is an opportunity of a lifetime, and the market's already cheap. So I'm super bullish on this. And then I think this goes the way of office space, right? This is apartments. Another area to stay away from other than office is apartment complexes. So huge development. Prices are not expensive by any means. If you look at it as spread to cap rates, they are, but on a trending basis, this asset class has been the best performing real estate asset class for 30 plus years in this whole rate decline. And so that's partially why I'm bearish on it. Number one, just the age of the demographic and household formation. I think there's going to be a bigger demand for horizontal multifamily yards, fences, right? Different family-based amenities than the traditional apartment complex. I think this is going to have a bit of an upset. And I think there's a lot of development on 2021.
And I agree 100%. That's why primarily, unless it's a unique opportunity, we've really stayed away from it the last really year, 18 months anyways.
Yeah.
But question for you. Let's go a layer deeper. What are your thoughts on affordable housing, subsidized housing, aside from your A class, B class? Just
blanketly, affordability is the lowest we've ever seen in history. And that only corrects itself through a couple options. One is income growth. Well, that's heavily inflationary. It's not going to happen. The Fed's crushing that, right? And the second is through price decreases. And that's what the Fed's attempting to do, because you have to kill demand. It comes back to supply and demand. So the Fed is controlling supply, and supply is short. If you just measure, a lot of single family homes have been gobbled up by Airbnbs, by investors, right? So it's really the supply of affordable housing that is distinctly undersupplied.
Yeah.
Because of the affordability index, which is at an all-time low. So that's the problem. And I think that corrects itself through pricing. So this is all the same function, money printing going crazy. And when the real problem turned in, which was I'm not saying it should or should not have been done, but the real problem was created when we gave money to individuals, because that created money velocity. So not only did you get money supply expansion, but you got people with money sitting at home with Amazon Prime accounts. And you had a locked up supply chain and things all messed up. It was like the perfect storm for an inflation catalyst. And once that inflation catalyst ignites, it's tough to put that, it's tough to put that back in the box, man.
Agreed. Makes sense.
So yeah, I think the affordable housing condition is based more on price than it is supply. I think that supply will be found. I'm already hearing rumors. I'm not going to name who, but I've seen deals across my desk of major home builders trying to jettison newly developed single family homes, get them off their balance sheet at significant discounts. So that's coming. Problem is investors aren't putting their money in this sector anymore. So
yeah,
it's too little too late. And the Fed, again, Mike Cantro, hope, right? Housing gets hit first, then new orders, then profits, then employment. Hotel real estate's the other area I like, Dana. Really love it. Lodging. You and I have been talking about this for a while.
Yeah.
I think you're going to have more of a hybrid work environment. I think conference centers are going to do phenomenal. I think hotels and lodging, even though they were disrupted by Airbnb, and I think the disruption or competitors here to stay, I feel like the ones who have been able to readily adapt and gain market share in the hospitality and lodging space are going to do phenomenal. Because you're going to need conference centers, you're going to need space to house employees and to have events to build culture. Because the metaverse just isn't here yet. Yep. I think the metaverse is a big threat to hotel real estate, but not now. People still want to get together. They still want to party. They still want to build culture. They still want to communicate and idea share. And I think that camaraderie will have a premium to it. And I think lodging and hospitality, especially business travel, is going to do phenomenally well. So that really wraps us up, Dana. Let's take questions, man, if you got any.
Man, I got a lot, and I know we're a little tight on time, so I'm going to hold questions from the group, but I'll take them. So write them in. We will answer them. I'll get back to you guys individually on those. I'll ping Clint if it's above my pay grade to get you a solid answer on that. But I guess just in summary, man, I agree with you. I think unprecedented times, but that creates opportunity. And if you're thoughtful in what you're doing and where you're going, you're managing risk appropriately, and you have access. You mentioned the manager in the shopping center space.
Yeah.
What I always appreciate about you is you bring opportunities that are unique. They're not most things it's not Blackstone REIT. It's unique institutional level investment offerings, but boutique style that I think creates another layer of opportunity, which is something I've always appreciated. So I guess I'll just wrap it up. Thanks, man. And for those of you that are watching, for those of you in the investment club, Clint's been gracious enough to grant us his time at least once a month to come on and talk about what's going on, what are some opportunities, where things might be headed. And so get used to seeing him a little bit more. And again, send in your questions. I'll get back to you individually. Clint, thanks, brother. Appreciate the time.
Thanks, Dan. Appreciate it, man.
Okay.